Hello, I'm Alex Davies, founder of Wealth Club, and today I'm with Ed Pryor of SFC Capital to talk about the startup funding club SEIS Fund. Hello Ed, welcome to the studio. Firstly, just tell me about SFC and a bit about yourself.
Thanks, Alex. It's very good to be here today. So SFC is the UK's leading SEIS fund manager. We've been in the market for about 10 years now. We've got a portfolio of 500 companies. And we also manage an EIS follow-on fund alongside that picks out the top performing companies for our entire portfolio to reinvest with. So my name's Ed Pryor. I'm head of investor services at SFC. I manage the fundraising teams and investor services teams. And I also manage our angel network, which supports our fund activity and helps our portfolio companies continue their fundraising journey.
So tell me about your SEIS fund. How many companies, what type of companies do you look to invest in?
Sure. So our SEIS fund, as I said, we're the market leader. We're winner of Best SEIS Fund Manager for the last 4 or 5 years now. We're a generalist fund, so we're seed stage specialists, but we're sector generalists. We're big believers in diversity, so that's in order to spread risk across multiple sectors, but also to capture multiple growth market opportunities. So whereas some SEIS funds are very B2B focused, or they might be very focused on just university spin-outs, we try and give investors a broad exposure to a broad spectrum of the innovation economy. So each portfolio will have between 15 and 20 companies within it. And these might be from sectors like climate tech. We're the UK's most active climate tech investor. We're growing more and more in science-led areas like biotech, deep tech, med tech is a big area for us, and really across that whole innovation economy spectrum.
So before we talk about the types of companies you're looking to invest in, tell me about the tax reliefs available to SEIS investors.
Sure. So SEIS is a uniquely generous tax relief scheme. So investors can claim 50% back on income tax relief. So if they were to invest £20,000 into an SEIS fund, let's say, they can immediately claim back £10,000 on income tax relief. Investors can claim 50% capital gains reinvestment relief on gains made elsewhere when investing into an SEIS fund or an SEIS qualifying company. If you hold the shares for a period of 2 years or more, then they are entirely exempt from inheritance tax relief. Now, this makes it a really, really important tax planning tool and is part of the reason why we've seen a march of IFAs enter the market more recently. There is also tax-free growth on the profits you make when selling the shares, so you'll pay zero capital gains tax when you come to sell those SEIS shares. And finally, there's loss relief at your marginal rate on the remaining 50% of the investment not originally claimed for under income tax relief. And actually, importantly, you can claim that tax relief either in the current financial year in which you make the investment, or you can carry back the tax relief to the year before.
And how much can you put into an SEIS?
So investors can invest up to £200,000 each year in SEIS, and that's actually been increased from £100,000 about 15 months ago. And that's had a really interesting effect on the market, actually, because we've now seen a number of ultra-high net worths enter the market for the first time because they see it as worthwhile. And at a time when smaller investors are leaving the market due to general economic conditions, that's having a very interesting effect on the demographic of the SEIS market, where we're seeing larger investors investing largely into SEIS funds, which is also changing the balance of power between direct investors and SEIS funds.
So it's fantastic tax relief, and you can invest more than you could. Let's talk about the investments. Where do you find the opportunities?
With SEIS, you're working in quite a volume game, so you need to look at a lot of deal flow. You need to kiss a lot of frogs to find the princess. And so we've actually been building up deal flow channels and deal flow pillars across the whole country over the last few years. So we have partnered with a number of universities. So I think about 15% of our portfolio are university spin-outs, but also UK's leading accelerators, incubators, and angel networks as well on a deal sharing basis. So that allows us to look at about 3,500 businesses each year, of which we'll invest in maybe 70, 80 new investments each year through our SEIS fund.
And how do you screen them?
So it's a big process to look at 3,000 businesses each year. So we've got our SEIS fund investment team that offer the first screening process, We've also developed this bespoke scoring system that we take every startup through. Now, this is a great way of managing volume, but also trying to keep a clear lens when we're evaluating new business opportunities. There are 60 different data points within this scoring system, and it's never moving beast. We try and improve it all of the time, but that really gives us a good leg up in the evaluation process. And we're really looking for a whole range of different factors in a business. Ultimately, each business needs to be able to have the potential to deliver outsized returns for our investors. We're investing in a portfolio, and we're going to rely on a few real winners to carry most of that value.
And are there particular characteristics of those businesses that you look for?
Certainly. So at the early stages, a big factor has to be the founding team. Business models change, businesses pivot, but people rarely do. And so you can get a good chance whether the business has a chance of being successful based on that early founding team. Really, we're looking at a whole spectrum of different things to evaluate a business. Levels of innovation, are they fulfilling an acute market need? Do they have the potential to grow into a large enough potential market to make it a worthwhile investment for us, even if that market doesn't necessarily exist today? Is there capacity to grow one? And a whole range of other factors. Really, ultimately, though, the team is the key point when you're investing at the early stages. Why are they the right people to solve this particular problem at this particular time?
And is there any particular right type of person, or does that change on the circumstances?
It changes on circumstances, and also the makeup of a team might change. You might have a team of founders that all bring in complementary skills. But some of our better investments have been solo-led founders. That's not a model we advocate for properly, because it's great to be working with someone to be managing your own sanity, but also it offers a level of assurance for the business as well. So there aren't necessarily specific factors we're looking for, but really, why are you the right person for this particular problem?
So can you give me a flavour of some of your recent investments and what they are and why you invested?
Sure. So a good one to talk about is Pipeline Organics, which is a clean tech company. Now, we've recently invested in them through our SCIS fund alongside Coca-Cola Ventures, and they've also got a £900,000 grant from Innovate UK, which again is both those factors are really good signals and make it, apart from the business itself, make it a very, very, very attractive investment opportunity. Another exciting business that we've just recently invested in is Adamo Foods. Now, they're driving sustainability in the food production process, and they were actually just named in Grocer as one of the 8 best British startups that are about to change the world. So that's a really exciting business. Another one which is has got very good coverage, actually, is a company called WineFi. Now, they're curating wine portfolios for investors. They're growing at over 300% month on month at the moment. So that's a really great founding team, really great founder, has brought in excellent advisors, and actually their early traction illustrates just how important that can be.
And what about some companies that you've been invested in for a longer time? Any highlights?
Certainly. So with SFC, we've been in the market for about 10 years, but we've done most of our investments and really scaled as a business ourselves in the last 4 years. So a lot of our portfolio is still relatively immature. We've got a great number of companies at that kind of Series A point, but some of our portfolio is much older, and so we've got great companies like Onfido and Cognism, who are both over £500 million valuations. And they're kind of a great demonstration of the SFC model, early doors. And then we've got, as I say, a whole load of companies at that kind of Series A, Series B stage, which are really starting to drive value for the portfolios.
To what extent do you get involved in the companies?
So, particularly at early stages, there's a really important role that we can play in setting up the right governance structures that will help enable growth. We're not there to run their business for them. That's the job of the founder, that's the job of the entrepreneur, but we can play a big role in supporting them through those growth stages, particularly before they get to that VC fund period and beyond. So we've created an ecosystem of support which helps them with specific aspects of their journey. So our Angel Network, which was last year recognised as one of the most active in Europe, is a great support on the fundraising side. Our portfolio team have also developed a proprietary platform that enables careful and clear and consistent reporting with our startups, We take a board seat on every startup that we invest in. And this really helps us to keep track of what is an ever-expanding portfolio, but also make sure that we can deliver value at scale for these businesses, whether that's through events we put on or through connections to different services in the market and so on.
And can you talk to me about exits?
Yes, of course. So we've had a really good amount of exits already in the fund. So we've delivered 30 exits to date, of which 10 of these have been secondary exits. Just to give a quick explanation on what that secondary exit means, it's where you sell a portion of your holding in a company, but retain some as well. So a good example of that recently is a company called Lunio, where we exited that business, or we sold 10% of our holding in that company, and that actually returned the entire value of the portfolio, which has de-risked that fund entirely. We've had a number of very big exits. So we recently, a company of ours, Onfido, achieved the largest tech exit in the UK for a number of years. That delivered over 100 times returns to investors, and we have others like Cognism that have delivered 75 times returns and more. We also have a number of companies that have exited quite early in the journey, which is great because it gets liquidity back to investors. So a good example of that recently was PeopleForce, which was a 5 times return for investors, which isn't as big as the 100 times and the 75 times returns, but it plays a really important part in driving value for each portfolio.
I was in that, and it came within just after 3 years, which is
exactly right. So the 3-year holding rule for viewers, you have to hold your SCIS investment for a period of 3 years to qualify for the tax reliefs, and so that's a really good example of just getting over that 3-year period and then being able to deliver value for the investor.
So there's potentially some very good returns to be had. What about the risk? How risky is this?
So early stage investing is risky by its very nature because you're investing at the earlier stages when there's the biggest mountain to climb for these companies. At the moment, our failure rate stands at about 15%, but that is actually not it's not a particularly helpful figure because most of our portfolio is still relatively young. And so we expect that to grow as time goes on. But that's why we adopt a portfolio approach to investing and why all investors should be adopting a portfolio approach in the early stages. That allows you to spread risk and cope with inevitable losses along the way, and also gives you enough space to find the 2 or 3 real winners that are going to drive most of the value in your portfolio.
Very interesting. There's a lot of appetite for SCIS at the moment. Why should an investor give their money to you?
So SCIS is in a really good moment at the moment. So about 12 months ago, the rules were updated to allow investors to invest more, which is up to £200,000 a year, allow investors to get access to more mature companies, so within 3 years of trading, which again helps to de-risk the investment somewhat. And the British early stage innovation ecosystem is in a booming sort of place. So it's a great way to manage your taxes, get access to the next generation of to the upside potential of the next generation of British innovation. And then for SFC, we're the most experienced SCIS fund manager in the market. We've, as I said before, have won Best SCIS Fund Manager for the last few years in various awards. And we've built our entire model around SCIS and delivering for SCIS investors. So we've got the grey hairs to show our experience, and we've learned to become very good SCIS investors.
Ed Pryor of SFC, thank you very much.
Thank you.
If you're watching on YouTube, please press like and subscribe to the channel for more.